Commonwealth Bank hit an all-time high recently and then had results and has gone up another 5.5% since results. It just can do no wrong. What is going on? The bank's results season has, and the CBA result in particular, has told you the story of banks. Their net profit number was down 2 or 3%. Their CET1 capital ratio, which is how much cash they've got on the balance sheet backing their business, that was higher than expected. In other words, they've got more capital than they need. Being prudent, they would have. And those two numbers themselves tell you what's going on with the banks at the moment and with the banks in general in the long term. They are not growth stocks, is what the net profit number tells you. They're not growing very fast, but they are paying, and this was the other statistic, 69%, call it 70% of their earnings back to shareholders as a dividend. So here you have the CBA's results. Profit was down a touch, but the dividend is still there. They increased the dividend more than expected, 250 cents compared to 241 cents. The management at the banks are very aware that the main attraction of the banks as an investment in Australia is to pay fully franked dividends, and a lot of retail investors in particular are in there for the dividends. So they like to keep expectations low and beat them, and that's what they've done with this dividend. They like to pay out a lot of their earnings as a dividend, and they have grown up over the decades into managements that will not risk the balance sheet, not risk the dividend in a chase for growth through acquisition. Instead, they are sticking to their knitting. They are turning that handle, turning those dividends out. And it so turns out that despite being at an all-time high, the share price has gone up again for the CBA on the results because they have delivered exactly what investors want, which is a great dividend and a quality earnings stream. They're not growth stocks, everybody knows that. We don't want them to become growth stocks and start making acquisitions with the capital they've built up on the balance sheet. We just want them to keep cranking out a decent profit and a dividend to go along with it. And if you looked at the CBA 6-month result, they've made $137 per man, woman and child in Australia. And that tells you if banking was a state-run enterprise, which we'd never allow it to be because we wouldn't trust the thieving politicians, would we? But if it was a state enterprise, then we would all be $137 better off. An enormous sum of money across a whole population. But of course, that money is going into the pockets of the shareholders. So they say when you get mad about the fees at the bank or your bank is charging you or interest rates, don't get mad, get even, become a shareholder. Many investors in the banks have made more money out of their investment in the banks than they've ever paid the banks, and they've paid the banks a lot. So this is what you want from the bank sector, and this is what they're delivering. No growth, no ambition, high dividend payouts, quality earnings, and we shouldn't expect anything else from them. Of course, at this very moment, the share prices look expensive compared to history. Most of the brokers on the Commonwealth Bank have target prices 25 to 30% below the current share price because they can't change their thinking that they should trade at the average PE they've traded at over the years. But at the moment, it is clear the banks are making a fortune out of the rise in rates. Their net interest margins are holding up nicely. It's a fantastic business, and all investors should hope they continue to do what they're doing, which is not a lot other than paying a dividend, and that's why the banks are where they are. As one commentator said, a Rolex is expensive, but a Rolex is good.